Coming up on today's show, will stocks make a comeback next week after today's slide? What do strategists think will happen in 2025? The very concerning signs in the price action today, and sentiment is officially bearish. What does it all mean? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks closed the holiday week on a downbeat note as Wall Street slogged to finish off a largely triumphant year. It was pretty red. It was pretty ugly everywhere. Everything was red from tech to semis, financials, consumer defensives, consumer cyclicals. Everything was red except for energy, which was actually just flat on the day. That's how you know it was a pretty brutal day. In fact, when you look at the advances versus decliners across the entire US market, we saw 4,600 decliners against 1,600 advances, with the majority of losses taking place right here, and the majority of that being the mega cap. And when that happens, you're gonna see the market slide. And it really was a mega cap story. Look at names like Tesla down 4% today. And again, there was no news, no economic data, light volume in trade. And that is something to note, very light volume today. But Tesla down nearly 5%, Amazon down 1.26%, Nvidia down 2%. Yes, bouncing off the lows right here, but still an ugly day all in all nonetheless. Only one sector gained today. That was the energy sector, which was flat down 0.01%. The SPY lost a full percentage point, and you can see the magnificent 7 sectors, XLY, XLK, XLC, all down nearly in excess of 1% and 1.35 and 1.67% for tech and the discretionary respectively. Then we actually look at what sectors outperformed, especially here at the top. Yes, still losses, but outperformed relatively speaking, and it was XLU, XLV, XLP. What do these sectors have in common? They are defensive sectors. So we did see, yes, declining stocks today, but a churn for defensive sectors. So this could be an early warning sign that Wall Street is preparing for a pretty big sell-off at the start of January 2025. We normally see these defensive rotations, these defensive trades take place a week or two in advance. If we continue to see utilities, healthcare, staples at the top of the heap relative to all of these other sectors, that is something to be concerned about. But one day's worth of defensive trade, nothing to write home about. We want to see at least a week or two of purely defensive rotation. If we get that, then we can start asking questions and diving into the data to see what it actually means. But it wasn't just large cap, guys. It was across the spectrum. Large, mid, small, they all took it on the chin today. In fact, small growth was the worst performing factor here today. But all in all, it was just an ugly day with mid cap value and large cap value seeing less of a decline than the other relative factors and size segments. And when you do look at it, inside the large value, mid cap value, you're going to see stuff like staples, healthcare, utilities. The defensive sectors are in this factor and size segment right here. So pretty ugly day for the market. However, when you look at it on the week, pretty green week, all things considered. Anytime the SPY is green for the week, you take those gains as they come, up 0.53%. But we really made some pretty highs. We made some good highs here in the middle of the week. Yes, it was a shortened trading week. And then we actually saw lower lows, lower highs to finish off the week. Every sector did gain except for the material sector. That was actually down 0.16%. Energy being the best performing, up 1.48%. Financials up 1.28% this week. So what we also did really see right here is probably just a little bit of profit taking into this week. When you're up like 2% into a Thursday, you may as well just take some profits, right? Especially towards the end of the year after the stellar rally we've had. But you can't discount the fact that we really did see a little bit of a defensive trade here on Friday. Now we want to see that continuation into next week. And when we look at next week's weekly sector analysis chart, we want to see stuff like XLV, XLP here at the top. If we get that that, then we can start talking about, okay, what does this defensive rotation mean for the economy, for stocks into January? But as of right now, we're just not seeing that, especially on the weekly basis. We saw it today on Friday, yes, but in aggregate, we're not really seeing that defensive rotation on a week-to-week basis. And we actually did have a fairly green week in this last 4 days or maybe 3.5 days of trading. So you can't really fault the market for taking a bit of profit here towards the end of the week and the end of the year in what was still a green week. To me, this just seems like healthy market dynamics in a low volume environment. However, something that is concerning is the moving averages. Now, the longer term 150, 200-day moving averages are solid, well in the green, but we did lose the 100-day moving average, which recovered yesterday. We lost it again today, and we did see market breadth decline throughout the shorter term and medium term averages today. Not a good look. We saw the 5-day moving average go from in the green to pretty much below the 40% mark, but it's very noisy. But then when you look at the 20-day, 50-day, 100-day, not a good look when you look at this, all things considered. However, guys, as long as these hold up, the longer term trend of this bull market remains intact. Longer term, we're looking really good for the market, but shorter term and medium term, things not looking good. And I would love to see the market go ahead and retake the 100-day like it did yesterday into early next week and just hold that for the rest of the week, and then maybe the 50-day as well. That would be very, very constructive for us to move into January, into the new year, because we move into the new year Tuesday, Wednesday next week. But let's hop on the charts. And today was just an ugly day everywhere. Equities fell in a significant way. Large caps, small caps, mid caps. We saw ugly action here in the bond market. That's because the 10-year and 30-year yield rose. The dollar was largely flat. And then we also saw, again, some ugly action here in precious metals, commodities, with Bitcoin down 1.27% and gold 0.637% as well. So, and there was no safe place to hide in the market today. Again, it just screams of profit taking after a very strong year, after a pretty strong week as well. And the market just saying, hey, I want to take the next couple of days easy. I don't want to worry about the markets. Pull in some cash, maybe look to deploy that cash at lower levels. However, the S&P 500 still looking largely constructed. You can see that the gamma flip zones haven't really changed. We are still in positive gamma, and we did actually see this red candle come after we had 4 blistering candles to the upside. However, we did gap down, but we did also see quite a bit of buying, because look at this week. If we actually just go to the daily chart, right, what we saw today, the 1-day chart in the S&P 500, a lot of the slide we saw was very, very early on in the morning. We then actually found a bottom here midday, and then actually made higher highs, higher lows, taking us back into positive gamma for the day. Now that is constructed, all things considered. Nonetheless, it was a red day, but we are still in positive gamma. And again, you really do want to buy the gamma flip zones, particularly because bears in bull markets tend to hold that gamma flip zone quite religiously. And you saw it right now. Yes, we did pair below it for sure. And that's exactly what we said at the start of this week. Once the S&P 500 and Nasdaq 100 go from negative gamma into positive gamma, we really just want to hold this gamma flip zone into the new year. We saw that with the S&P 500. We saw that with the Nasdaq 100 as well, although we closed slightly below it, but we are still consolidating at this period right here. And then for the RTY, the goal for this week was for us to actually go ahead and recapture this gamma flip zone. We did not do that. So things looking really not constructive for small cap names, but I think large caps, with where they are right now, how they're consolidating, particularly the S&P 500, it does look poised to sort of just consolidate here and then continue the move higher, especially if we hold this low. If this low holds this low right here, it would just be a higher low relatively speaking, and that would just mean trend continuation. It is healthy for markets to do this type of thing if we get consolidation. However, things not looking constructed for the RTY, because this is a fairly weak uptrend and we didn't actually recapture gamma flip. You don't like to see that. And then looking at the RSP today, very, very similar situation to the RTY. We're not really seeing the same type of follow through that you would expect and that we're seeing from something like the Nasdaq 100, which retook its gamma flip, and the S&P 500. So all in all, guys, I think the place to be, the place you want to be, is still the large cap space. Yes, we did have some ugly price action in the large caps. And yes, the RSP did outperform the large cap names, relatively speaking. But if you actually look at small caps, large caps did outperform stuff like the IWM, the RTY, as well as the S&P 600. So the place to be is small caps. And if you are looking for discernible value, maybe the RSP, the S&P 500 equal weighted We're getting a little bit of volatility in what has been a fantastic week and a fantastic year. And look, you really shouldn't be trading aggressively towards the end of the year. I told you guys this yesterday, and I will probably for the next couple of days. The only thing you want to do is just hold the positions you have right now. If you want to take a bit of money off the table, go for it. But you don't want to be adding aggressively to any positions to try and eke out gains for this year. Any positions you do add to your portfolio today should really be a longer duration trade through to the end of next year. You don't want to be aggressively trading. You want to be making strategic moves in your portfolio this time of year, particularly when we get dislocation like we did today. Then you can add to the names you like. And you guys know the names I like. I still like PayPal. I like Paycom software as well. PayPal had a fantastic year. Great name. I still like PayPal. I still like Paycom, guys. These are two small cap, mid cap names that I would personally buy. In terms of the mega caps, I personally do like Google. It's still well under fair value. My fair value for Google is about $220. I also do like another large cap name I've been looking at, Uber Technologies. I think this is a great spot to get long here for Uber. I think anything below 60 is just a steal. And I think we should see a run up to its all-time highs sometime into next year. I think all of the news and sentiment behind this is largely overblown. And then to play real estate next year and rate cuts, Pexa Group. This is a name I like. I think the stock is going to go to $30 next year. Then we're going to see a massive rally in this name. So these are the individual names I like. And if you really are contrarian, Estee Lauder, but this is more of a 5-year hold, a really long duration hold. And then Evolution Gaming, there's a lot of bad sentiment behind the stock, but the fundamentals are just amazing. It just has to get past some of the sentiment we're seeing right now in the stock. But company growing at mid-teens, high double-digit growth rates, trading at a single-digit forward PE. You love to see that type of stuff. So those are the individual names I like. You guys know the S&P 500, the Nasdaq 100, the RSP, stuff like quality small cap. So if you are adding, add for 2025. Other than that, enjoy your holidays, guys. Don't trade too aggressively. Preserve some capital if you can. Take some money off the table if you'd like to as well. We've had a great year. We've had a fantastic year. I do think we go higher into next week, into the interim. This probably will be a higher low, and we continue to move higher in the S&P 500, followed by the Nasdaq 100. And for the RTY and the Russell 2000 to do anything next week, they have to take the gamma flip zone right here and then make a move. If they don't, continue to see the churn we'll see, which is what we get in negative gamma in something like the Russell 2000.
And let's talk about sentiment. This is the AA sentiment survey. And guys, we've seen a very clear trend in the last month. Despite the market continuing to move higher, we have seen breadth dissipate in the last month. And as a result, bullish sentiment has pulled back. However, what it's really been is just simply a normalization from pretty excessive bullish levels right here to pretty much the historical average. So we have about the average bulls that we typically see in a bull market, but we do see slightly elevated amounts of bears relative to history, and we have seen bearish sentiment increase as bullish sentiment has decreased. This has coincided with, yes, a lot of volatility we've seen in the last 4 weeks in the month of December. December has pretty much been a flat month, but at one point we were down nearly as much as 4.5% in the S&P 500, and as a result, sentiment is showing this. Nonetheless, we are still in a bull market, and yes, bearish sentiment is elevated, but so too is bullish sentiment relatively speaking. There are still more bulls in this market, and this can flip on a dime, and that tends to happen in bull markets. And it's not just retail that's bullish, so too are the analysts, guys. And right now, we have 4 analyst price targets: Oppenheimer, Wells Fargo, Yardeni, Deutsche Bank, above the 7,000 mark. This is about 14% from where we are right now, and we can see we have a very tight cluster of analyst expectations for year-end forecast 2025 from the 6,400 to the 7,100 level. And the last time we actually saw analysts in such a tight grouping with their next year forecasts was in 2017 and 2008. We had a tight consensus estimate of year-end price targets. What happened in 2017? We absolutely smashed those targets to the upside. We saw a very similar situation in 2008. We had a tight band of consensus estimates, and we absolutely smashed those estimates to the downside, however. So if history is anything to go by, this just tells us that analyst price targets, when they're very, very tight, like they are right now for 2025, we often see the market smash those expectations either to the upside or downside. And we actually have the data on that. Strategists often just miss the mark when forecasting. Looking at predicted and actual returns for the S&P 500, you could see that we almost never ever predict the actual return, relatively speaking. So do take these estimates with a grain of salt. However, one thing you do want to take into consideration is that most of the time, the analysts actually predict the direction. So they don't get the exact number correct, but as you can see, they do predict the direction, which for into 2025, the direction that most analysts are looking at is for the S&P 500 to move higher. Whether that means we finish at 7,500 or 6,500, at the end of the day, the general trend tends to follow the expectation of analysts and strategists. And for 2025, that direction is to the upside, and the path of least resistance is clearly to the upside, especially when we have earnings as such as they are. The third quarter 2024 EPS estimates surprised in a very big way. Almost every single sector didn't surprise. Industrials was the worst. They had a 0.7% upside surprise. Discretionary the most, with the average surprise coming in at 2.6% above the analyst expectations. And the biggest earnings beats came from Tesla, Marathon Petroleum, Eli Lilly, Goldman Sachs, Mondelez, CRH, Meta Platforms, Nextra Energy, and ADP. And guys, when you smash analyst expectations, that really bodes well. And any pullbacks we do get in the market, any volatility we do get, when you see this type of thing, you want to buy those dips because it often just means short-term weakness. And you also want to buy dips when the macro is favorable. Guys, the US Economic Surprise Index, this is the zero line right here, has consistently been above the zero line. In other words, we are seeing more upside surprises and downside surprises. However, we have seen quite a bit of a pullback since late November, and this has coincided with tightening financial conditions. You can see that financial conditions have tightened ever since the Fed decided to cut rates, and that's why we've seen a little bit of a pullback in the overall economic surprise index. Nonetheless, we're still above the zero line, things looking really good overall for the economy. And even if financial conditions do tighten, it's not necessarily a bad thing, because look at this chart right here. This is very interesting. When interest rates go up, car sales should go down, but that's not what happened in this cycle. And this just really goes to show just how strong corporate America is and the average consumer. Car sales actually moved up when the Fed started to hike rates, and that really goes to show how strong the US economy is. And we continue to see this strength despite tightening of financial conditions. We continue to see US exceptionalism. Now, looking at next week, guys, there's virtually no earnings, but we do have some big data points. On Monday, we have pending home sales, month over month, year over year. And on Tuesday, we don't really have much of anything. We got the home price index. That's about it. Wednesday, we're closed for New Year's Day. Then we back open Thursday. We get the 30-year mortgage rate, initial jobless claims, and the PMIs. And then on Friday, we get manufacturing PMIs and ISM employment manufacturing. So not a massive week of data, but we will be kicking the year off with a bang because we enter the new year on Thursday, 2nd of January. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.